Hey everybody, welcome back to The Educated Consumer with Hunter and Sam. Today we're going to talk about something that we get asked
a lot
about
Yes.
in the mortgage business, and that is whether to do a 15-year loan versus a 30-year loan. You know, you've probably heard that a 15-year might be better or a 30-year has a lower monthly payment. We're going to dive into all of the ins and outs between these two loan programs or loan terms, and
what makes sense.
You can make the decision
not
that's
one
best
size
for
fits
yourself.
all. Correct. It might be good for one person and not good for other, and part of it is really understanding the difference in the two.
Right. So kind of jumping into it, Hunter, let's break down the basics.
Okay.
On the differences between a 15-year mortgage and a 30-year mortgage.
Yeah. I mean, I think on a really basic level, which is we don't want to get too in the weeds, right? So a 15-year term, right? It's going to be a shorter term, which means, you're going to have 180 payments versus 360 payments. And so what does that mean? Typically, you're going to get a lower interest rate going 15-year, which is great, right? But the payment's going to be higher, right? And so with interest rates a little bit high right now, do we want to sign up for a higher rate, right? That's, again, we got to break it down and figure out what makes most financial sense for us, because every loan's going to be different. And then here's a big one, right? If you do a 15-year, the amount of interest you pay over the life of that loan, it's so much less than a 30-year, but payments are higher. So, right? And then it's like, hey, what's a 30-year term, right? So a 30-year term is 360 payments. It's going to be 30 years of a fixed rate mortgage. The interest rate's a smidge higher, right? Lower payments to start, but more interest paid over time. And so when we're looking at that on a level, Sam, let's talk about let's look at some numbers, because at the end of the day, we can talk about, hey, payments are a little bit
lower
higher.
interest rates. What does that mean? 1%, 2%?
That always piques my interest when you hear lower payments. Yeah.
Yeah.
So break down for us, let's visualize it and see. Tell me what it looks like if I did a 30-year mortgage or a 15-year mortgage right now.
Yep. All right. Let's look at the monthly payment differences.
That's a big one.
So with a 15-year mortgage, you're paying off the principal faster, which means
winning.
That your monthly payments are going to be higher.
Yep.
Because you've got a shorter term, you're going to be paying less interest overall. So for the numbers example, if you borrow $400,000, your 15-year mortgage payment, principal and interest, would be around $3,300 to $3,600 a month right now, kind of in that mid to higher 6% interest rate range, which we're seeing
currently
right now.
Yep.
And on the flip side, if you go with a 30-year mortgage,
spreads my term out longer, pays more interest over time, but gets my payment lower.
Exactly. You'll be around $2,400 to $2,700 for the same loan amount. So that
about
option,
a $900 swing, roughly.
Right.
$800 to $1,000 swing to cut my term in half.
Right.
Okay.
And so that's just based on a $400,000 loan amount, which is probably almost average on what we're seeing
in the market. I mean, I think, pretty accurate there.
And I guess just kind of to touch on interest rate for the 30-year option, that's going to be kind of high 6%, low 7% range. So generally, what we're seeing right now is that the interest rate on a 15-year loan is about 0.5% better.
Yep, 100%. That's fair.
Say.
And sometimes, depending on where the market is, you might see a little bit bigger of a gap. But typically, even when rates were 2s and 3s, it was about a 0.5% swing or difference in payment. So that's a good range.
Yep. And so now let's look at long-term costs. Kind of zooming out a little bit, total interest and long-term costs over the life of the loan. So the same example of the $400,000, let's compare the 15 and the 30-year mortgage. So with the 15-year at a 6% interest rate, so going a bit lower, right? Being optimistic.
We're adding there.
Of course, 12 payments a year. And let's say you started it in March of this year. With no additional monthly payments, that scheduled payment is going to be $33.75 a month. And over the course of the loan, you're going to be paying a little over $200,000 in interest. Okay. $576 to be exact.
So make 180 payments on 6%, and total interest paid over the life of the loan is about $200,000.
Right.
Okay.
That's the number to focus on.
Yeah.
When you're looking at, of course, total interest savings over the life of the loan.
That's a big one. A lot of people don't look at that. You know what I mean? You just we look at payment, right? We don't fixate on, hey, what do I pay in interest back to the bank? We need to be looking at that.
Right. Absolutely. So let's take the 30-year mortgage, same example.
Yep.
6.5% versus 6.
Okay.
Standard kind of 0.5% that we see higher. 30 years, 12 payments a year. Your scheduled payment is going to be $25.28. So, a good amount lower for most of us, right? Can definitely stomach that.
Yeah.
But the con to the 30-year is that you're paying over $500,000 in interest. So over double the amount of interest over the life of the loan. $510,172.
Yeah, that's a big number. I mean, it is.
And so really, I think to kind of wrap things up and go back to more generalized pros and cons, just because you're paying more interest over the life of the loan on a 30-year mortgage, it doesn't mean it's worse than the 15-year.
Correct.
So talk to us a little bit about more specific situations. What should I be looking at? Exactly.
I mean, again, I think we said in the beginning, one size doesn't fit all, right? I mean, you need to talk to a mortgage advisor that's going to break these numbers out and really look at your budget, because budget's huge, right? Last thing I want is a consumer to, sign up for a 15-year mortgage thinking, oh man, I'm going to pay this off sooner. But it stretched them. It stressed them out. Them really have to change their lifestyle or really have to dip into savings to make these payments. It's like, if you're comfortable with the payment at 15-year and it's not going to stress you and you can put your head on the pillow and sleep at night, do it, right? If you look at these numbers and you're scared by them, don't, right? I mean, it really boils down. Owning real estate is still a smart investment, 30-year, 15-year. The idea is I'm going to pay that asset down and I'm going to gain appreciation. I'm going to build wealth that way, right? Just with a 15-year, I can build that wealth probably a little bit quicker. I'm going to pay less interest to the bank. So I love the 15-year. If you can afford it and you can stomach the payments. Give me some feedback. What do you think?
I think it depends where I go with this. It depends what other investments you have, to me.
Yeah.
If you already invest in the stock market pretty heavily and you're a first-time home buyer, with the higher interest rates from an investment standpoint, it makes sense to go the 15-year. Because interest rates are higher right now and you're pouring more into principal to kind of diversify, right? Because at the end of the day, your house is an asset.
Still an investment,
and you've got other money parked in retirement account, brokerage, what have you. That would make more sense to go 15-year. If you're, newer in your career and your house is, kind of wiping out the savings or taking up most of your savings, I would not go with the 15-year. I would go with the 30-year, take that extra money. It would be, this is easier said than done, but take that extra money and the difference in those payments and put it into some different investments to kind of diversify a little bit, because you need all of these things to accumulate wealth.
Yeah, I agree.
And I think throwing it into
one basket.
A retirement account, brokerage account, in the long run will be more beneficial to compared to having to stretch to make
truly
that
build
mortgage
wealth.
payment.
If you look at over 15 years of where I'm looking at a 15-year mortgage, and I'm early in my career and I don't have a lot left over, and so I do the 30-year and I diversify, you're going to have more money at the end of that 15-year term than if you do a 15-year mortgage and don't diversify and put money elsewhere, right?
Exactly.
Yeah, I think that's great guidance.
So, all right. If you have any specific questions on your situation, obviously we are here to help. We can lend in all 50 states. And until next time, see you later. Make good choices.
I love it.